We did have Delta earnings this morning, came in on a beat on EPS and revenue. I'm looking at the forward guidance, and the forward guidance actually looks above expectations as well. I know Stock Talk was talking about that, a pretty decent report. What's Delta stock doing here in the morning? Up about 5%. I'm sure the travel names, let's just look around very quickly in RCL. Not really moving off of it, but we'll see that one. Taiwan Semi had its fastest monthly revenue growth since 2022. The AI chip boom came in at $6.1 billion, up 34.3% year on year. I wouldn't be surprised if that gave us like an NVIDIA upside off of this one. No, not really. All right, fair enough. We have about 4 minutes until the CPI print comes out anyway. Apple, there's a report saying that 1 in 7 of their iPhones are now assembled in India, keeping on that conversation. There was a story this morning that Roblox is continuing to try and get advertisers into their game. They literally have full-on billboards in a video game, which is kind of funny to me. But fair enough. I guess that's the world we live in. All right, we got 540 of you in here just hanging out on this Wednesday morning, waiting for the CPI print. Kevin, I want to circle it back to you. You kind of were talking there that your inclination, obviously we don't know, but if you had to put the guess on it, you seem to think that we might be getting a hotter number here. What do you think is the underlying cause of that? And if we were to get a weaker number, where do you think the weakness would be? Or when I mean weaker number, I mean below expectations, so like a 0.2 or 0.1, and what would be that kind of disinflation part of it?
Yeah, I would say just from the energy side. So last month, I just got the number up too. Last month, I thought we saw gasoline at around 3.8% on that increase. But if you're looking at the national average from AAA, or even if you're looking at the futures contracts, they're up about 8%, and they continue to rise. So I would say just from the energy side, realize on that front. And then also when you're kind of looking at the utility pipe, I think my eye out on that as well. So natural gas has actually declined, and when you're actually looking at spot rates, what people are actually paying for on a month-over-month basis, utility companies continue to charging a fair amount of the energy side. Realize on that front. And then also when you're kind of looking at the utility side, I think there's so natural gas is probably decline pressure and once again kind of looking at the manufacturing PMI, still hearing commentary around the shipping issues, and then service PMI, we saw prices still increasing or in expansion territory. They did decelerate a little bit, but once again, those pressures are kind of there, and the transportation trend continues. That'll also put some upward pressure. And then, like I said, the shelter component is the hardest one for anybody to really try to model out because it's not the best calculations, at least. It's a certain component that also can sway that number, but we just haven't seen that crack yet. And so I think when you're looking at the commodity space as a whole, not only just energy, but some of the raw input goods when it comes to food, from coffee, cocoa to egg prices, and actually egg prices went up like 75% in February. That wasn't really realized at all in the CPI print as well. So there's a lot of different factors on the commodity side that this was not actually realized within that CPI print. So that's where the feeling comes in at when you're looking at the commodity space that maybe we do have a little bit of a hotter print, but on the apparel side, and kind of getting that data point coming from Ulta, I believe that was last week where they revised their guidance. It seems like they're seeing a pretty rapid deceleration when it comes to sales, and then that's also impacting margins. We saw a sell-out across the board. So you can make the case as well that maybe apparel also come down pretty strong. So that's kind of the thought process.
Number is reported on the BLS.gov /CPI, and you can find it there. But came in hot. What we get?
We have headline CPI year-over-year went up to 3.5% from 3.4%. Month-over-month was 0.4%. we had core CPI actually increase, or not increase, it stayed the same at 3.8%. Market was looking for 3.7%. Core CPI month over month came in at 0.4% versus the street's estimate of 0.3%. We have the E-mini S&P 500 down right now about 0.75%, down about, let's say 0.7% at this point. So we are seeing a sell-off. Kind of talked about it yesterday too. There, the little spaces, like the market was definitely rolled up. So hot print could have a lot of people off sides, not only just retail and speculative traders, but also market makers who are also positioned as well. So let's see how the market's going to be reacting to that. If market makers are going to have to sell along with retail, or if market makers actually try to buy into some of this volatility.
Yeah, market is definitely dumping a little bit off of this one. We'll keep an eye. With these things, a lot of times the first move ends up being the wrong move. But yeah, SPY's down about 0.8% now. Views are down about 1.1% in pre-market trading. Like Kevin said there, appreciate him. First of all, you guys should give him a follow. We have some guys he's talking about. Shout out AJ and Stock Talk as well. Check them out. Across the board, the CPI came in hot. The last couple prints, it feels like we've been getting a lot of inline numbers, and this was the first one where it's coming in a little bit above expectation. Pretty much every single number is 0.1% above what the market wanted to see. So, interesting stuff going on there. I'm going to try and get the buy category number up in a second. But yeah, core CPI was both above expectation, 3.8, 0.4, 0.1% above, and then 3.5 and 0.4. Both of those. Let me get the table 2 up and dig into that one. I know people like to look at the kind of, yeah, go for it.
Yeah, I was just going to say, also just keep your eye out on yields right now. The 10-year futures are sitting at pretty much, you're sitting at 4.491. I mean, I wouldn't be surprised if we get 4.5% of that 10-year right now. It seems like wow, it just actually happened. So 4.5% of the 10-year would not be actually very surprising. Dollar spikes, the dollar's up about 0.5% right now. But we are, like you said, the first move is usually not the right move, right? So you just have to have this settle out. And I think the market reaction, for the most part, is the appropriate one right now. And if you actually look at the metals, I want to just bring those up right now. Metals are actually selling off as well, which is actually very interesting to see. Silver is pretty much flat on the session, just about, let's say 75 cents, and then gold down about 0.5%. So even if we did have that reflation trade that has been a miracle here, maybe there's already been positioning on the metal side compensating the top. Hopefully, some of the correlations that we've seen break the last couple of weeks starts coming more into alignment, because everything was breaking down as far as dollar and the equity markets, dollar yields, metals yield. I mean, there was just a lot of disconnect.
Interesting. Appreciate those thoughts there. Getting the CPI by category up as well. Interesting. The biggest downward areas, definitely the fuel, oil, and utility gas services bringing us down. Airline fares down 7.1% year over year. That seems to be one that's been like that. But motor vehicle insurance up 22.2% year over year. Was this one that was always high, the motor vehicle insurance? I remember there was a point where it might have actually been bringing us down, but interesting. Transportation services being pretty high as well. The owner's equivalent rent is definitely the one that's bringing up. Looks like the most here. That one's up 5.9% year over year. Obviously compared to the average of 3.5%. So pretty well above there. Interesting. AJ, what do you watch?
Fuel's now pricing in just fuel's now pricing in just 50 basis points.
Sorry, what did you say, Stock?
You're saying 2 rate cuts this year is what it's pricing in right now?
Yep.
Interesting.
So,
it was all the way at 6 at one point. We've come a long way.
We've come a long way. So what I'm watching now, as Kevin would allude to, is something that him and I, our trading styles, right? So now that we've got this move down to about 51, 55-ish on SPX, right? Give or take a couple points depending on where you open. all of that put positioning that was open on 80, 70, 60 is now in the money. So now it's going to cause the dealer to be extremely short because all of that monetization went from out the money because think about it this way, we were higher to lower. So what I'm watching now is if those start to monetize again, people start taking profits, it can create a short-term bounce off that 50 level on SPX. Or if the dealer is forced to become more short in the book, i.e. play with everyone else starting to dump their longs and go short, you could have a nice 2% possible down day from here on out. So that is what I'm watching from here. So my key pivot is going to be 51.50 to 51.45 on SPX to see if that line in the sand breaks, and that's going to be my positioning for the rest of the day. So that's what I'm watching from here. And like you said, Evan, you're right. Reversals have happened on initial move after open. And that's sometimes a result of something like this when everybody walk away, and you get the reverse effect. So not possible, but that's what I'm watching for now. And it looks like we're losing that 50 level as we speak.
Talk. I know we've been talking. The market has not been able to put together, a down 2-3% day in a good little bit, and it's also not been able to do like a couple days in a row of actual meaningful downside action. There's been down days, but there tends to be reversals. There tends to be this and that. We get down about 3%, and the market shoots up. Are you kind of what are you watching for the day today? And like, is this you think we're still kind of in that trend, or are you kind of just letting it play out and seeing, hey, maybe this is a down 2% day, which has been extremely rare recently, as AJ was talking about? I just got a notification, Bitcoin now back under 68K. Fair enough.
Yeah, go ahead, Stock, as you're back on.
I was just gonna say IWM's down over 3%, enormous move. And
what's your thought? What's your thought on this downwards move? I know we've been talking about how strong this market has been. It gets a 2-3% pullback and it just rips back up. It's not been able to do it down. Do you think that? Are you watching the market for today? Obviously, it's been a little bit of a change of character over the last month from the 4 to 5, 6 months prior where it was straight up, and now it's a little bit more sideways, showing a little bit more weakness. Do you think it's time for the market to finally give us that 1 or 2 actual down days?
Yeah, I mean, this is probably the deepest reaction in high beta that we've seen from any print out of the last, I don't even remember the last print we saw. IWM and KRE down 3% a pop. RK's down 3% too. So all the high beta indexes are down like big off this. The Qs are down 1.5%. So yeah, this is a deeper initial reaction than we've seen in a while. Does that mean we're going to get a couple days of correction? I don't know. I don't have a crystal ball, but I'd like to see a pretty aggressive recovery at the open if you want this to not turn into a couple days of sell-off. I mean, a 3% move is big. That's a big move in an index. And yeah, I mean, look, there's a lot of people that are looking at financials and small caps a couple of weeks ago. Those are going to have a really hard time performing in a tape like this. It goes even higher today. What is it doing right now? Yeah, so it's up like 0.13%. It's pushing that 4.5 area. If 10-year breaks out above 4.5, you're probably going to get a little bit of unraveling, some froth coming off the top. So we'll see. We'll see how the market reacts to this at the open. Like you said, sometimes we've seen kind of V-shape reversals in price action, but I also don't think we've seen this deep of an initial reaction.
I'd watch for the reaction on the VIX. So what's occurring on that right now is it's spiking over 16, which has been a big key pivot, right? If that fades, right, combined with that area 45 holding on the derivative side on SPX, it can be a strong candidate for a V-shaped bounce, right? Because what's happening is all those premiums will get repriced. Your Vegas will get re-impacted from the resultant of a change in ID. The Bahamas, all the other derivatives will get re-impacted. And then what occurs in the market structurally is the dealers are able to reposition themselves. And the folks that were short, if they start taking their profits off the table, and closing their position is forcing the dealers to go long or buying with re-hedging occurring in the market, which leads to a reshift. We've seen it over and over and over again. Structurally, that's what's occurring in the background, right? So for folks that have seen that happen, I'm not saying it will. I'm saying it's a probability game. I'm saying that's what happens in the background from a dealer perspective.
The Fed swaps getting to the point now where we're at 50 basis points of rate cuts only this year. On the CME Fed Watch website, the CME Group website, I've never seen it this lagging, which I think tells you a lot. It's actually now there's a 51.9% chance the market is saying that we do not cut rates in July. That the first rate cut comes in September, which I think we actually no. I think it's the November one. That's a day or two after the election, which would roughly the election at the same time every single year. So I should know that probably. But Kevin, I know you've been looking at these interest rates and you've had some thoughts. What do you think of the market starting to price out a July rate cut and it's getting to September being the first one? Are we just continuously getting closer to the market maybe getting around that we may not cut rates this year?
Yeah, I mean, that's always a possibility, especially if these trends continue. And that's, what I've been kind of harping, right, is the fact that there's been a lot of talk about this disinflation narrative. And yeah, we were in disinflation for a very long time. But the issue that we had is a lot of that was base effects, and then we had this inflationary moment when it came to the commodity space in October, pretty much October through January for a lot. But a lot of that was again, just facing chart action as well as just seasonal effects. And now these commodities are not outside of the norm. A lot of these commodities do catch a bid during the spring and summer months. And so we did not have that same type of situation this time last year. It was kind of off cycle when it came to this commodity space. So you're not going to really have decent comps on the energy side or even the metal side until you get to around July, August, or September of this year, right? And that's assuming that the price is staying where they're at right now. So yeah, it's going to be a little bit harder. I kind of go back to the fact that when the Fed puts out their economic summary projections, right? That's not like set policy. But the problem that they kind of have too is that you don't want to put out 3 rate cuts and then not cut at all, right? It's all a credibility game. So will we have rate cuts this year? Maybe. I think there's still a possibility that it's out there. We have 3 rate cuts. If you look at the calendar, and I know a lot of you probably heard this before, I'm going to say it again though. If you kind of look at the calendar, you really only have you have to basically start in July if you want to get 3 rate cuts. Because we have 6 meetings. We have May and then June, which right now we're probably not going to cut because of the data. Then you have the July meeting, which you can cut once. We have the September meeting, where you can cut again. We have the November meeting, where it's like the day after your election. I don't think the Fed's going to do anything then, especially how contentious this election may be. And then you have December. So, they're going to continue to push it back as much as they possibly can. And then once again, once you get to July, though, a lot of this impact or pressures from commodities go down. And they might try to utilize that one print that we do see the disinflation occur again, and they might say, okay, we're on the right path, seasonal stuff's out of the way, at least start the cuts. And if you start the cuts, it doesn't mean that you have to continue to cut every meeting. I think that's a misconception that's out there. They can start the cuts in order to kind of get the first one out of the way, and then kind of communicate to the market what their next steps will be moving forward, as well as the QT policy as well. Quantitative tightening, they're letting a lot of these bonds roll off of their balance sheet. When they roll off and mature, they're getting the cash back, right? It's refilling their own reserves. If they stop that policy, that's going to be a really telltale sign too. They can't get too far behind a lot of the other central banks, though. So they can't get really too far behind the ECB, which from their data points right now looks like they are primed to be able to cut in June. And if they cut in June and we don't cut until, like, say, February of next year, that's going to put some excess pressure on the dollar to the downside. And a lower dollar, a weaker dollar is actually inherently inflationary. It does actually spark economic growth in industries like industrials and materials, which is good. That's a good thing in some respects. But if we have this rapid move to the downside when it comes to the dollar, that can also be bad and make the ability to be able to tame inflation that much harder. So they're in a rock and a hard place, and I'm not even done to the fiscal side of government trying to fund us trying to fund the government and what we're doing right now. So there's a lot of factors that are in place, and there's really no really great options for the Fed. They're either going to have to put the hammer down and squash this inflation situation and stop trying to really ease into it, or they're going to have to communicate to the market that they won't say it explicitly, but they communicate to the market that they are willing to accept some of this seasonal, quote unquote, seasonal inflationary pressures, and then also start to cut as well because of their fear that the labor market could also fall off, and that could be a signal that they could do as well. None of them are really great options. I think if they communicated it right, the consumer, the average Joe, the average Jane that's out there, you've told them, hey, we might have 3% inflation, but we're going to have a robust job market and wages can continue to stay not at these levels relatively and outpacing inflation. I think the consumer would be okay with that. I think if you go the other route, I don't think the consumer would be okay with that as well. But yeah, it's a tough, it's a tough situation. This is something that I've definitely been harping on. Probably been annoyed for the last couple of months, but this is exactly we'll see how the Fed's going to have to spin this one around. I mean, even if we don't cut, some of the economic measures are still decent. And then you have to think about, okay, well, what's the actual normalized rate that we want to have anyway? Are we going to get 6 cuts? Like, do we need actually 6 cuts in order to get to the Fed's target of long-term scale? Maybe not. You don't have to. We're a lot more resilient than the market expects. And then this will be the last point that I say is there is some cracks though for the lower end of the economy. Pretty much anybody that's making like $170,000 or less, which is actually 90% of all Americans. You're looking at household income or personal income. They are feeling the pressure. FHA delinquencies are moving to the upside. You're seeing an extension and elevation of utilization rates for credit cards. I mean, there is some pressures out there. You got to also be mindful of them too, because they consume the most. Like, it's kind of like it's a situation that's not a good one. But yeah, I'm not surprised by this one. I kind of said it yesterday too. I may have been off. I thought I was offsides yesterday, right, compared to everybody else's expectations, but it looks like it wasn't. So
Wow.
that's kind of what the Fed's got to do, and that's kind of my thoughts on this number, and we'll move forward. We'll digest it and move forward. We have earnings that kind of talks about it. And if Delta is, because I was surprised by Delta too. If Delta's trend on how they're going to achieve profitability and maintain profitability this year is going to be the trend for all other industries, where they're basically telling you, look, our top line growth, we're good where we're at. We're going to try to cut costs and expand margins, and that's where that's going to be the meat and potatoes of our strategy. Then that's going to have a downward impact when it comes to rate growth. It's just one earnings announcement, but that could be the trend, and that's kind of what analysts are pricing in when you're looking at the earnings estimates for the S&P 500 this year. So outside of the Mag 7 that has a secular trend, we might see expenses be the biggest focus this year. It's not going to be top line.
Be interesting to see. Definitely a couple companies. It's been a little bit of a theme focusing in profitability. You've seen a couple companies just miss their EPS and get destroyed, especially when they miss their EPS guidance. That's definitely been a big one here. I think of companies like an Amazon, which I know you said the mega cap 7 might be a little bit out of that, but they've definitely been focusing on the profitability. They've been able to turn it around pretty quickly. Interesting stuff going there. Before I keep us moving along, I do want to make sure we're going to go for another like 10, 15 minutes or so. I want to make sure I get the 9 a.m. news done, see if anything comes there. Make sure you're following speakers up here, though. I really appreciate them for joining in and hanging out with us for this CPI print, watching how the market's doing. So make sure you're following Stock Talk and AJ and Kevin and Emperor Dor, who I'm about to go to here. really great people, will improve your experience on this app. And the truth is, you can't follow them later if you don't like the content, but you will enjoy it. Really smart people, appreciate them. You should also follow mine again if you enjoy free news. But Mr. Emperador, how are we doing today? What are you watching?
Hey, good morning, everybody. Thanks for all the thoughts that have been shared so far. Just digging into these numbers, honestly, I decided a binary event like this and tight range movement and consolidation range that I wasn't going to trade anything, get my head ripped off this morning. But now that we have the move, I'm starting to look at some of the levels I've got down here. Digging into these numbers a little bit, it was mentioned, the auto insurance, some of the shelter stuff. Also noticed it hadn't been mentioned yet, the medical care. Looks like it's hospital services. That one kind of surprised me a little bit. So I'm going to dig into some of those healthcare names and see what we might be able to find over there. I'm kind of reading through this report right now, the 38-page PDF they put out. Yeah, interesting that the healthcare stuff is up a lot. Let me see what it looks like. It was flat last month in February, basically unchanged, and now it rose 0.5% there. Hospital services rose 1.0%. So interesting there, the healthcare part of the report.
Definitely an intriguing one. I appreciate you bringing that up. I know that's one that Jaguar's been pointing to a bunch of saying, this is where the numbers have been for the last little bit. It just doesn't make sense. And I know that it's a weird one because they've been changing the methodology and changing everything. Stock Talk, actually, I'm getting a headline right now. 10-year Treasury yield jumps back above 4.5% after CPI tops estimates. So exactly what you were watching before is happening. And I appreciate the thoughts there. It's definitely